Policymakers at the ECB have raised concerns that Eurozone growth could prove weaker than the upbeat forecasts issued by staff. I'm joined by Dr. Frank Hollenbeck, Professor of Finance at the International University of Geneva, to look into this further. Welcome, Frank.
Good to be here.
So, Dr. Frank, we have strong consumer confidence numbers, we have good PMI numbers, we have a growing sentiment that growth is, picking up in Europe. So what can you say about this?
Well, I've been doing interviews for about 4 years, and every spring we talk about growth picking up, okay? And in the case of growth in Europe, it's primarily being driven by improvements in Germany, primarily in German exports. But when we look at growth potential, for example, in Italy, even the government anticipates growth to be only 0.7% this year and under 2% over the next 2 years. And with budget deficits over 2%, that just basically means that Italy's debt to GDP ratio will continue to rise. So even if we did have growth in Europe, it's just saying that we're heading toward the cliff at a slower pace, okay? But we're still heading over a cliff in Europe, okay? And where is the growth coming from? It could be because of lower oil prices, but we have to remember that lower oil prices is going to cause a significant economic adjustment in the United States. Many shale oil companies needed prices above $65 a barrel just to break even, and we have that financial institutions in the U.S. have lent over $1 trillion to energy industry, which means that if we have a recession in the United States, it's not going to impact the United States, but it's also going to impact the world, including Europe.
And of course, Greece is still dominating the headlines. So in relation to the Eurozone, are they in or out?
Well, we can say that Greece is what we can say is between a rock and a hard place, in the sense that they don't want to implement the austerity measures that are being required by Eurozone countries, okay? But at the same time, they're running out of money, and they need these funds to be able to cover not only the repayments that they have to make to the EU, but also to cover basic government expenditures. So the real crunch is going to be in June. My view is that once the Syriza party was elected, the Eurozone countries should have just said, no more money, okay? In the sense that it's the second most important lesson in finance, which is sunk cost analysis, in the sense that you don't throw good money after bad. And in the case of Greece, they clearly have no intention of continuing with austerity. So we're heading, like I said, is we could have a financial crisis, because we must never forget that the money that was given to Greece was actually guaranteed by Spain, Italy, and France. Actually, 50% was guaranteed by Spain, Italy, and France.
And of course, it's been almost a month since the ECB implemented its bond buying program, so likely to continue.
Well, of the 60 billion they were supposed to purchase, they only purchased 47 billion euros, okay, of which a large proportion of that, I think almost 11 billion, were German government bonds, okay. Now, we have to realize that these bonds, these German bonds, are actually trading at negative interest rates, okay. But negative interest rates are actually showing how the European Central Bank has totally distorted one of the most important prices in the economy, which is interest rates, because interest rates basically align output with demand across time, okay? And to be honest, if I was a hedge fund manager, I almost have a certain profit, in the sense that I could short sell, for example, a 1-year zero coupon German bond, okay, and receive 1,013, put it in my mattress, and then pay off this bond of 1,000 euros in a year from now. Well, that's a certain basically no risk arbitrage opportunities, and those things shouldn't occur in a functioning financial market. But that's what the ECB has created by inducing negative interest rates. To be honest, we now have 2 trillion euros worth of government bonds trading at negative rates, which is simply shouldn't be occurring and is an aberration of a capitalist system.
As always, some wonderful insight from you there. Thank you so much, Dr. Frank.
No, I was glad to be here.
That's all from Dr. Frank and myself for now. Thanks for tuning in and be sure to keep clicking back to Dukascopy TV.